Hello world! Welcome to Farm the Market. This is a weekly stock market recap. Let's review some of the things that I found the most interesting during the week. Expect the expected move. Last week I mentioned the dissonance between the feeling many had about how volatile the week was and the fact that we didn't even touch either edge of the expected move for the S&P 500. This week is a different story. We tagged the upper edge as soon as Tuesday and stayed very close for the rest of the week, closing Friday about 20 points above it. This is more in line with what market participants should expect. In general, the expected move should be expected on either side. I know, that sounds obvious, but that's the way it is. These levels are also really close to all-time highs, so many things are converging. This past week, the expected move was about plus minus 157 points. But for the next week, it goes down substantially to only about plus minus 80 points, almost half the range. At a quantitative level, it makes sense, given the dive volatility took this week. But in a fundamental level, we must remember the FOMC meeting for this week. The announcement takes place on Wednesday. It will be interesting to see how things develop. Remember the old saying, don't fight the Fed. VIX Futures curve, business as usual. The first 2 months of the VIX Futures curve went back into Contango as soon as Monday, cutting the backwardation streak, if we can even call it that, to only 1 day. The curve kept correcting into, let's say, textbook Contango during the rest of the week. This was a good sign to start the week for people long the market or directly short volatility. As I mentioned on the last weekly recap, this happens often. It's not unusual for the first 2 months to switch back after only 1 day. Having said that, it's always a good practice to be aware of these changes. After all, to start a backwardation streak, you always need that first day. To put this into context, here's a simple summary of how often this has happened in the past 10 years. Feel free to pause the video to take a closer look at the numbers. I want to be very clear. This is not meant to be a signal to go long or short the market. No single metric can tell you that. Never. This is just something to be aware of and incorporate into a deeper analysis of the market. VIX closes under 20. Not my favorite metric, but lots of people pay a lot of attention to the threshold of 20 for the absolute value of the VIX. So, I just thought it would be worth mentioning that after closing above 30 last week, we are back again under 20 on the VIX, whatever that means. Thinning the herd. Although the market had a good week in general, if we measure it by the performance of the S&P 500, I just wanted to remind everyone that many names that were market favorites in 2020 keep having a terrible 2021, especially many hyper-growth names. This is important because in general, when market corrections, or worse, come, like in nature, the weaker animals are the first to be attacked. I'm just going to use the ARKETF as an oversimplified benchmark for the group of stocks that I'm talking about. As you can see, after a wonderful 2020, 2021 has been cruel to this sector. Therefore, the phrase thinning the herd. This keeps going on. Slowly but surely, each week that passes, the market relies more and more on the big names to hold up. This is no secret to anyone, and it's natural for a market cap weighted indices to function like that. But it's important to keep in mind, the burden keeps increasing in a few names like Apple, Microsoft, Google, Tesla, and Nvidia. For example, for how much longer can call option buyers keep pumping up Apple? Just wondering. If you found this information useful and interesting, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Remember that everything presented here is for educational purposes only. Thanks for your time.